When geopolitical tensions rise in the Middle East, the United States is often viewed as insulated. Since the fracking boom of the 2010s, the U.S. has produced more crude oil than any other country on Earth. But the latest economic data shows that domestic supply does not guarantee price stability. In April, U.S. headline inflation reached 3.8%, the highest level since May of last year. Among G7 nations, the U.S. currently has the highest inflation rate, outpacing Europe and Asia. The primary driver is energy. Between February and April, U.S. energy inflation spiked to 17.9%. In the euro area, that same figure only reached 10.9%. This leaves the world's leading oil producer weathering a steeper energy price shock than the nations that actually buy its fuel. Domestic production has not provided the insulation many expected, leaving the U.S. economy more exposed to global volatility than its importing allies. To understand this vulnerability, we have to look at the baseline state of the economy in February, before the current conflict in the Middle East escalated. This gauge shows that U.S. inflation was already elevated at 2.4%. This was significantly higher than France at 1% or Germany at 1.9%. At that time, the only G7 nation with a higher inflation rate than the U.S. was the United Kingdom. Because the U.S. entered the crisis with higher baseline inflation, it had less of a buffer to absorb the sudden increase in global commodity prices. This exposure is tied to oil intensity, a measure of how much fossil fuel an economy must consume to generate $1 of GDP. Currently, the oil intensity of the U.S. economy is roughly twice that of the European Union. Even with record domestic output, American consumers don't get a homegrown discount. Because oil is a globally traded commodity, U.S. producers sell at international market rates, leaving domestic gas stations tied to global volatility. Unlike petrostates like Saudi Arabia or Russia, the wider U.S. economy is too diversified for oil revenue to support the national tax base or offset these consumer costs. While high prices generate record revenue for the energy sector, those gains are outweighed by the costs pushed onto the rest of the high-intensity economy. By contrast, European economies have spent the last decade shifting toward alternative energy. By lowering their total consumption per dollar of GDP, they have become more resilient to price spikes, even while remaining importers. Consequently, the sheer volume of domestic production cannot offset the costs of a high-intensity economy when global prices climb. When inflation rises, the standard response is for the Federal Reserve to raise interest rates. This makes borrowing more expensive, which slows spending and cools the economy. However, higher interest rates are politically unpopular. Slowing the economy can hurt a sitting president's re-election prospects by lowering growth numbers. Donald Trump has signaled a move away from the tradition of central bank independence, calling for lower interest rates despite high inflation data. This campaign has included public pressure on Fed Chair Jerome Powell and investigations into the central bank's internal operations. If Powell is replaced, Trump's nominee, Kevin Walsh, has reportedly indicated a willingness to cut rates in the near future. Lowering interest rates while energy costs are still rising risks accelerating the cost of living crisis, as more money enters the economy while supply remains constrained. This leaves the U.S. in a difficult position, structurally dependent on a volatile global commodity, while the primary institution used to control the resulting inflation faces increasing political pressure.